So foreign trade policies also envisages, also given a target to achieve a 2 trillion in export goods and services by 2030. And in a trade policy, so many concessions, even the interest remission, other things has been allowed to the SME sector, beside the link, protection link incentive to the SME sectors. It is also envisaged to cover all the risk because there are two, three the important aspects in financing of the export. First, the assessment of the limits, how you can assess it when you got a export order, how the bank expediently can sanction the loans. Second point will be to cover the risk in case of the failure for the buyer to give the payment or other things. So credit guarantee, export credit guarantee corporation is available to give a credit. When we see when the developed country and comparing with the India, so percentage of coverage is quite less. Even packing credit and export credit, these are being covered by the censor, state government enterprise in China. So we are lacking in some respect. The major aspect today, webinar we are going to discuss how it is different from the other credit and how the bank consider. This is the most important aspect. How the bank consider to sanction the export credit. So today, webinar, we are having a quite number participants beside the YouTube and electronic medias and on the Research in India platform. So we have already done 227 webinar during the financial years. And under the association's banner, we have done about 47 webinars under this series. So dear participants, so we will come back in respect of today's webinar. My suggestion at the opening is anything you require, so we are here to help you. This webinar is done in a collaboration with the ICICI Bank. ICICI Bank officials are also here. So we also request you, please free to ask any question from the banker. If you require any assistance for export credit, please approach the ICICI Bank for any assistance for that or any doubt, any clarification, because they are playing very important role for the growth of the export credit. So I will not take much time. I am only requesting Shri Gaurang Baswada sir, please take over the session and give your thought. I think we have done 7 or 8 webinar under the ICICI banner. So what I have got a feedback, his vast experience, his knowledge, I think there is no match for that. You must appreciate him. And I hope that today's webinar will also going to be proof useful for our entrepreneurs who is participating in this webinar and getting the clarification from him. Any doubt, please, my request to have an interaction. Give us your question so we can reply to that question. The expertise opinion, you can get it from the banker, Mr. Santosh Pandey sir is with us, who is also clarify on the behalf of the bank. So I now request to you, Gaurav sir, please take up the session. Gaurav sir.
Thank you. Thank you, Mr. K. Gupta. Thank you for putting the perspective in place. I must thank AFI and Research in India for inviting me here, and thanks definitely for to the bank for being on board, and we will be able to clarify some more things from the banker's perspective. What I carry and what I tried to prepare when I thought of challenges by SMEs are all those points which I have learned over the last past 4 years or so post my retirement from the bank. And those points I would like to touch upon where maybe there are issues by the corporates, by the exporters, maybe on the limit sanction side or on the process side, etc. We'll try to cover that. Very aptly put in by Mr. Gupta that you cannot delink finance from exports. And since we are now slated to grow our exports from roughly 776 billion to $2 trillion in next 6 years, uh, maybe the role of finance which it plays cannot be undermined. The major concern is that on one side we say that the exports are not growing, and on the other side we also find that there is no growth in export finance. Now, taking these two together, what we need to do is to manage exports and manage export finance both in such a way that the growth in export finance becomes a tool to grow our exports. Uh, so, navigating export finance challenges for SMEs. So, we'll just discuss what is exports and what is export finance, how it is different from domestic finance, some perspectives or prerequisites on processes, sanction, etc. What challenges are there, what documents, quantum, cost, how to navigate that particular aspect, and what are the other modes of export finance, and definitely question answer we will have. You can also type in your questions in chat box. I'll take from there. No issue. Or raise your hand subsequent to the presentations, and then we can take all the questions. So, what is exports in fact? Now, when we talk of exports, we are sending some goods out of the country, or maybe providing some services out of the country to a person resident outside. So this is how FEMA is declared, or FEMA is maybe defined export with its grammatical variations and cognate expressions to taking out of India to a place outside India any goods, or provision of services from India to a person outside India. Now, when the goods are going out, when the services are being given out, why does FEMA come into picture? It comes into picture because ultimately, when I am sending goods out or services, it should be paid through the inward remittances. I must realize and repatriate the proceeds, and it is that dollar within inverted commas. It is that foreign currency. It is that foreign exchange. It belongs to the government. It belongs to the state. Now, when we talk of exports, I have an order, I do a shipment, I wait for the payment, but there is a gap. The gap is of the requirement of finance between the order and the shipment. At the stage where I am required to procure raw material, then I am required to process it, pay for labor, maybe those in the garment industry would require some ari-tari to be done, or maybe some bead work to be done, or some assembling work to be done in the machine tool industry, etc. And once the shipment is done, then I have to pay for the payment, and there also I am out of funds as an example. So these two places are there where I need funds. So in fact, I need funds from the time I get an order and till the time the buyer pays. Now, this buyer would pay me as per the terms of contract, or he may not be as per the terms of contract, but delay the payment. So the requirement of funds could also be delayed in such a manner. In 1967, till 1967, this was not a separate subject at all. As an export finance, it became a separate subject in 1967, where only rupee finance was allowed. And the motto there was to make short-term working capital finance available to exporters at international comparison. So what we are talking of the merchandise exports or services exports is on a short-term basis, maybe 3 months, 6 months, 9 months, maximum 1 year basis. And in 1992, when we saw that a lot of FCNRB funds were lying idle with the banks, etc., then RBI introduced the scheme of this foreign currency financing in the form of PCFC. Now, there is one master circular on export credit and customer service way back issued in maybe till 2015-16, it was getting updated. And most of the things which could be left to the bank on the pricing side, process side, etc., have been handed over to the banks. Banks are free to do that. It's a free competitive market now. But some of the things on interest ceilings, how what the service factor should be, etc., are all mentioned in that. And that 2016 circular is still valid. Now, when in today's seminar we are talking about merchandise exports, so if somebody is looking for the exports relating to projects or maybe the long-term service contracts, maybe the software industries has got a long-term service contracts, maintenance contracts, etc. Those are all defined under the deferred payment terms and are covered under the project and service exports memorandum issued by RBI, and which is a separate document, separate topic. Now, when I talk of export finance, what do I consider? So, finance allowed for promoting exports. This is the motto from the government, from the Reserve Bank, that I want to promote exports. Hence, I must see export finance with a different eye, different nature. I should see, and what normally I call it, that since the country wants to promote exports, we need to pamper exports. We'll see how all it is to be done and what is the responsibility of the banks also there in that. Now, this export finance within the definition of Reserve Bank of India can be allowed to domestic tariff area units. Maybe if my unit is in some industrial estate and I intend to export now, or I'm already doing exports, I am doing domestic now, but I intend to go for exports, I can avail export finance within the definition of export finance. And also SEZ units, special economic zones. Now, SEZ units would also include various EOUs, hardware technology parks, software technology parks, etc. Everything. And something is also there as a deemed export, where the goods actually are not going out of India, but the person who is supplying under the deemed exports is leading to savings of a precious foreign exchange. Instead of bringing in the foreign exchange, I am trying to save the outflow of the foreign exchange, and that will be considered as a deemed. So in all three segments, export finance at the given conditions, pampered way can be allowed. Finance for procuring, processing, manufacturing, and packing. So this is one stage between shipment, between the order and the shipment. And the another stage is against export receivables. When the shipment is made, a bill is raised, so it is called a bill finance. Now, this RBI circular very clearly lays down the expectation from bank. I've just narrated it so that we know that how and the way bank should behave there and what can I demand from the bank, both sides. Because I normally am now speaking as I am an exporter and what I should know so that I can talk to the banks in a better way, or maybe I can engage with the banks in a fruitful manner so it benefits. Meet the genuine credit requirement of the export sector promptly and in full. So if I have an order and I go to a bank, I am already availing a limit, but if I have an order, then if the bank finds that this is a genuine credit requirement, then the bank should come forward and give the credit, and it should not be a half plate, it should be a full plate. Maybe just what 10-20% margin is there. But if somebody says, I'll give you 50% of the money, then I'll not be able to export. So promptly, the timeline is given there and in full. Flexible approach on debt equity ratio margins. What debt equity ratio we demand for domestic sector? That should be diluted. If I am taking a margin of 25 or 30% for my cash credit limit, then I can always go and relax it as a 20% for export finance. And also, in domestic, I may be demanding higher security. I can always dilute that security requirement for exports. Quantum of finance. Now, quantum of finance, it is said that it should not depend on what security is being offered, but it should depend on the expected turnover, orders in hand, capacity, capability, etc. of the entrepreneur. Now, why so? I have an export turnover of 1 crore today, but I expect 2 crores to happen by March 25. It has to be calculated on a 2 crore turnover basis. If I've already, maybe in a 6 month period, I've already crossed 1 crore rupees, then another 1 crore it can be seen that I can do in the next 6 months. And instead of going by my audited balance sheet of the maybe March 24 or so, the bank would always consider the projected turnover and then see it, and also see that whether the capacity is there in the entrepreneur to do or accomplish that. If I say that I will go from 1 crore to 10 crore, then this question mark will always be there from 1 crore to 10 crore. How do I have so much machines? Do I have a setup of the plant? All those things will come in. But reasonable expected number should always be accepted. Now I have a set limit, but every time I need to tell the bank that I have received an order. So against letter of credit or confirmed orders, banks to satisfy about the standing. Now I must go and tell the bank, sir, you have sanctioned the limit, but I have a copy of the order here. I received an order for $50,000 or $1 lakh, and I need to procure raw material. Please release the funds now. So the releasing of funds will always depend upon the availability of the order, except in certain other circumstances. Banks to satisfy about the standing of the issuing bank or status report of the overseas buyer. Now, why I have kept it here? Because on one hand, it is the bank which is financing you. But if as an exporter, I do not satisfy about the issuing bank, and there we find a lot of exporters getting caught into a wrong net, or the overseas buyer's satisfactory report. It will cost a couple of thousand rupees only to find out from ECGC or Dun and Bradstreet or asking a bank to get the credit report. Maybe 5,000-7,000 rupees banks are charging now from Mira Inform or some other agencies which are providing. Go and get the credit report of this buyer every time whenever you are entering or trying to get into a business relationship with a new buyer. Whenever you are receiving an LC under a contract, ask your buyer to give you the name of the bank. And then go to your bank and say, sir, if this bank is opening an LC, whether this is a bank, worthy bank that you will accept it or not. Are you going to negotiate the documents under that LC or not? If your bank is shaky, then please don't accept that bank. Ask the buyer to get the LC confirmed from a reputed bank in India. So let it be confirmed by ICICI Bank, HDFC, SBI, Bank of Baroda, so that you know that my money is safe with these four banks, and I need not to resort to a bank in Kenya or maybe Madagascar or any other place. Sanction of export credit facilities. Now we see on the first line it is say promptly. It is not that when I get a proposal, I should sit on it or maybe refer to drawer, which is the common language used in the banks. But if it is a fresh limit, the maximum time I can take is 45 days. Renewals is 30 days. Ad hoc limits is 15 days. Now, this prescription is of what 2016. And our technology has moved from 2016 to 24 many a times. Now there is no need to move the files. So I think that the fresh limit should be sanctioned within 15 days. And if any renewals or ad hocs are to be given, they should be given in 2, 3, 5, 7 days maximum. These limits are maximum as prescribed in 2016 circular. But now in certain banks, the files do not move. It is all electronically that files move and it go up for sanction also. Even in our public sector culture, there are SME factories in larger towns. So whenever even the files are moving, it should not take larger or a longer time. So essentially, export finance is a two-level finance. For financing of purchase, processing, manufacturing, or packing of goods prior to shipment. So I must decide that if I have an export order of, say, maybe $100, my cost of raw material and the cost of manufacturing goods, including the labor charges, electric charges, etc., would be around, say, 70 rupees. So, based on that 70 rupees, I have to calculate, and then the bank could sanction me that limit based on that 70 rupees. Working capital expenses towards rendering of services in case of service export. Their cost would be manpower, the biggest cost, and the other cost would be the rental for the space. Because if I have a BP of 200 people sitting and doing some accounting job, and then the air conditioners running so that electricity bill will be too high. So all these will be working capital. And against that, I can also draw the money because in service exports also, it is not that I will get the money in advance or everyday payment. It also has a cycle that every month I have to draw in a bill. After 1 month, when I draw a bill, it is paid in 15 days. So total 45 days are gone. For that 45 days, I have to arrange for the funds. On the other hand, post-shipment finance, once the shipment is made, or the services have been rendered and an invoice is raised, it is called post-shipment after shipment of goods. Now, after shipment of goods, why it is a separate segment? Because the goods are not in India. They have already sailed. There is a bill of lading, shipping bill there. Services have already been provided, only invoices there. So now these becomes receivable. Till pre-shipment stage, the goods are in India, either in a raw material form or maybe I have already manufactured something, but it is within the charge of the exporter. The charge of the exporter means it has a charge of the bank also. And once the goods are put on sale or they have been shipped, then the goods are out of the country. So now only the bill remains on which the charge can be. So it becomes a receivable finance. Why export finance for exporters and no other finance similar to this? Because we need to promote exports, and our first statement, we need to pamper. We need to see that more and more exporters avail finance and through which they are able to grow the export. Maybe some other XYZ conditions would always be there. So let us see what is the difference between domestic finance and export. Now, why this is important? This is important because in today's time also, there are people who have been doing some business here in India for last 5, 7 years. They do all domestic business and they avail cash credit or overdraft limit with the banks. And all of a sudden, maybe the second generation or the next generation comes in and wants to start export business, and they are already doing exports. But they have never told the bank that now, henceforth, the turnover will be of 80% domestic and 20% export. And they continue to avail cash credit limit without seeing that if I go in for an export finance, what pros cons is there or what benefit I can avail from the bank additionally. And if you are a manufacturer, so in today's terms, you may be eligible for subvention or the equalization benefit of 3% as given by the government. That is why this difference must be understood. And once you understand this difference, maybe there are issues with export finance. Don't deny that. But that does not mean that because this is something which is hitting your bottom line. Domestic finance could be in the form of cash credit, overdraft, maybe pledge limit or hypothesis limit. Then there could be a term loans for procurement of machinery or maybe setting up of offices, etc. Then also I have inland bank guarantee, import bank guarantee, inland or letter of credit for inland procurement of goods or imported raw. Now, when I talk of this, I have certain conditions. Cash credit or overdraft limit is a checkbook facility. I get a checkbook when the bank opens a CC account for me, or I have an RTGS rights also there. So I can draw as and when I want. Then there is a requirement of submission of stock statements every month, every quarter, every half year. And then if it is a term loan, then installment repayment. And now the next stage is that you have a cash credit limit, but they say it is on a reducing basis. What does it mean? Every month you have to reduce the limits. I don't know why. If for a business it is required, there is no need to have an installment repayment for a working capital limit as such. It could be for a mortgage loan, but not for a business loan. Then this is a continuous facility because I have a checkbook. I can till the bank stops that facility, I can draw it. So even when my limits are overdue, I can draw from that by way of RTGS or checkbook by drawing the check for a certain period. And it does not monitor that how the funds are coming. It should be from your any of your sales or any other thing. Maybe if I have sold my furniture of old furniture of the office, that also I can put it in my cash credit account. There's no bar on it. But when I compare this to export finance, something else is there. It is a two-stage finance, pre-shipment and post-shipment. and I can also avail pre-shipment finance on a non-fund based basis if I want a letter of credit or an SBLC for procurement of raw material from the domestic supplier or from a foreign supplier. So non-fund based pre-shipment. Now, when I compare this with the conditionalities on the right side, there is a difference totally. This is what we call this is a transaction banking. For each transaction on the pre-shipment or a post-shipment file, I have to touch base upon the bank. Transaction banking. Each transaction I have to touch base upon, maybe electronically also, but at least touch base. I have to approach the bank. For each drawdown, if I want 5 lakh rupees or 50 lakh rupees from my limit, I must submit the documents, including the copy of order policy or a bill, and then draw. So submission of documents is a prerequisite for each transaction to be done on a pre-shipment or a post-shipment. Now, this does not have a checkbook or an RTGS. For each drawing, as per your request, the bank is going to open a separate dummy notional account to monitor your due dates because every drawing is based on your order or a bill, and each that will have a due date. Each drawing is tenor based. So if I am procuring something, maybe for on a post shipment side, one order could be 90 days shipment, another could be 180 days shipment. I am procuring pre-shipment finance against an order which is a 60-day shipment date is there, another is 120-day shipment date. So it will have a different tenors, and for that matter, bank will open different notional accounts. Now, the pre-shipment finance, I cannot deposit the money by sale of goods locally or by sale of furniture locally, as I can do in a cash credit. It does not distinguish because the color of rupee is domestic. Here, the color of that funds which should come should be from the export proceeds. So, pre-shipment ideally is adjusted from maybe by purchase discount negotiation of the bill, and the post shipment is liquidated from inward remittances that the bill has been paid by a foreign buyer and the money which is coming from abroad, ideally from that. Here, largely there is a concept of credit insurance. In large number of banks or in maybe a couple of banks, we can say now, there is an export credit finance. ECGC is mandate. And in new private sector banks or maybe even State Bank of India, I understand that they don't have an old turnover policy, but they insist the buyer to have a policy on the post shipment. Buyer takes a policy. So the concept of credit insurance is largely built in because I am taking exposure on a buyer who is not in India or abroad. In CC, with credit insurance has not yet creeped in, except when the banks are trying to disperse the or distribute the loans amongst themselves for a large, very large corporate. Now, domestic finance, there is generally the general interest rates are applied, normal interest rates are applied, and usually there are no subventions, subsidy. So why I have written usually is that there may be that there is a subsidy given by state governments to MSME units on certain drawings are there, etc. There that could be there, but in general that is not there. It is not a central government, maybe anything which is being done to Reserve Bank of India. So ideally, the domestic interest rate, domestic finance of cash credit overdraft will depend on the repo rate today, which is 6.5%, and the spread could be 4%, 5%, 5.5%, 4.5%, something like that. So on a general aspect, I have written it maybe a medium size. Agar corporate is there, then he could get a bargain of around 4% above repo rate, so the interest rate would be 10.5%. Now, as compared to this, export finance is a concessional finance. Banks are bound to give the best possible rates here based on their cost of funds. So we call it a concessional interest. And government also announces subvention from time to time that the interest equalization schemes currently going at 3% for MSMEs. A couple of months back going at 2% for non-MSMEs and 410 items. Prior to that, 3 years back, it was 5% and 3%. Different schemes are there. So what my comparative rate is? The concessional interest meet, I will not pay 4%. I will pay less than that, or bank should demand less than that. So it is a 3% spread. So my total rate is 9.5%. Now, if I am an MSME unit, as on date, I am eligible for 3% subvention. So my net rate becomes a 6.5%. This is a domestic fund. The inflow, outflow, everything is rupee. Here, the inflow is expected to be in foreign currency largely. I can also book forward contracts and thus reduce my cost and bring my cost below 6.5% also. Rupee finance below 6.5%. So maybe if I am able to do a forward on an annualized basis, it is 1.5%. Maybe net to net, if I am able to get 1% of the differential for a 6 months forward, then my cost comes to 5.5 also. So this is how that differential is there. So I must know the difference. So if people are there in the domestic trade and who are having maybe even 10% of their trade as a export finance, go and get your limit bifurcated into domestic and export finance. Or maybe 1 crore rupees of total limit, out of which 15 lakhs can be availed for export finance, some limit. Get it done because you will get some benefit out of it. 1% saving is nothing. You find that it is nothing, then it is okay. But now I am showing you about 4% of the saving. 3% subvention and 1% spread, 4%. Plus 1% a year also you can save. Banks, normally we see the banks sanctioning credit limits. So we will see what all issues are there and how to navigate those issues when we are talking to banks about sanction of credit. One second. When I go for a sanction of credit limits, there are application forms. Maybe hard copy, nowadays soft copy also. Those forms will have a lot of details, including my past track, my previous balance sheets, and maybe a forecast of 25, forecast of 26 also. Because if 6 months have gone, then maybe better to see the forecast of 26. So one aspect is that wherever I find it difficult, don't declare or don't write anything which I don't understand from the exporter's point of view. Ask the bank, what should I do here? Understand and then write, because it should not go as a wrong declaration by you. As an exporter, please see that you don't wrongly declare anything in a form. Write all correct information based on documentary evidences, based on your audited balance sheet and a forecasted balance sheet. The normal is that what I want, I will put my maybe my turnover figure and then maybe come downwards to see that how I get the money. It should not be done. Ideally, try to engage with the bank in a truthful manner so that bank is always loyal to you and you remain loyal to the bank. Now, another question is whether it's an existing business or a new business. Now, largely the banks will see the past track record. What is it? The past track record. If somebody has a past background of doing business, the bank will always see that, okay, he's doing business now, then there is no problem. He will also manage, or he should also be able to manage the exports. Although that's slightly different, but to have a business acumen, somebody from the business family. Maybe I am a new generation person, but my father has a business or we have a family business. And I want to establish a new business on the export, new line for exports. I have a business acumen because I have also handled that domestic business of my maybe father or the family business for a couple of years or some months. But somebody coming with a totally new business idea from a salaried background, etc., and then I want to leave the job and do the business, then it will be slightly difficult for me to explain to the bank that whether I have that capacity and capability to handle that business or not. Doing a job and maybe getting into a business is different, and the banks, since they are lending you the money which they have borrowed or taken as a deposit from large population, then they are more scary on the side. So I need to engage in a proper manner. I should have a better plan and don't jump upon the export orders there. It should not happen that when I'm entering into a new business or a new export, I jump upon orders and then get it on the wrong. The other aspect which can be that if existing business with an existing export turnover gives more comfort because The exporter would be knowing international business. He would be knowing documentation. He would be knowing negotiations. He would be knowing the markets, etc. What products are in demand? What products can be supplied? But somebody into a domestic exports and now want to enter into exports, then also banks may ask you several questions and I must be prepared on that. So the navigating part of what I will face when I approach the bank. Past track record, last 2 or 3 years track. Now, past track is what? The bank or the financial institution want to be assured that you are into business for last couple of years. How this is handled? Maybe I have set up a new firm for exports, but I have a backing of my family business, which is into business for last 5 years or 10 years. And maybe I can go to the same bank and ask for limits. They also know the track of my family business. They know that the behavior of the business or businessman is fine. They have a good track record. Based on that, I should be able to convince the bank to give me some money in the new firm, maybe based on the guarantee of the existing firm or the business, and then get the funds for export. Security related. This is one big aspect. People have security, may not be ready to give the security. People have security, the bank is not agreeable to take that security as a security because it is not maybe approved by the lawyer or the legal team. Or the value of the security is far, far less than the expectation of the banks. Or the banks say that your security is X amount, so I will give only up to X amount, or maybe X plus 10%, 20%, not more than that. And some places you will find that your property is X, so I will give X minus 20%. Because it is only a market value. I will not be able to realize. So it's two different things. Now, if I have a security, I should always offer that security and offer the good security. How banks are comforted with the security? Banks are comforted with the security. Maybe a security is there. But if I have a plant and machinery, I have a factory premises, and then I don't want to give it as a security, then bank becomes suspicious on. If I am staying in a rental house, then it is fine. But if I am staying in my own house or if I have my own office and then I say that I don't want to give a security to the bank, then also bank will become suspicious. Why? And banks are not financing the security. For that, you can always get a mortgage loan, property based. But they are financing your business, but want to know your seriousness about it. And if I see from the perspective of the exporter, when I'm growing my business, the value of the property is not going to grow at that speed. Or I cannot bring in a property every 2 years, 3 years to get my announcement. So what do I do? So I will have to negotiate maybe with the bank that the bank tries to relax the security requirement when my announcements are there. Maybe I can give a comfort with my strong balance sheet, the capital which I have put in, the flow back of the funds which I have done. Instead of taking the funds out and buying a property, I have kept those funds in the business itself. That should provide the comfort to the banks. And costing and the condition. Costing we have already seen. Now, on the costing side, since banks are lending, they will put the costing based on the risk assessment. If they find that it is 100% securitized, there is an existing business, the past track is good, the risk is low, then the costing could be low. But if this is all is not there up to their expectation, then they will always put in certain margin to cover the risk on them. And the conditions relating to pre-shipment and post-shipment. Maybe I have not covered those conditions today here. When you draw the pre-shipment, there are certain conditions to be seen. When you draw the post-shipment, there are, and we did in one of the other seminars, I think, 2 or 3 months back, when we went through the entire gamut of export finance on the RBI. Competition of credit limits. Now, when I approach the bank will compute the credit limits with various methods. One is MPBF, maximum permissible bank finance, turnover method, and the third one is operating side. Now, let me take the turnover method first. 20% of the projected turnover, very straight line method. I say my turnover is going to be 22 crores in the next year. Bank agrees that okay, from 1 crore last year and 1 crore by September this year, you will be able to achieve 2 crore. That is accepted. So straight away 40 lakhs is given. But in an export business, some of my orders are 60 days, 90 days. My manufacturing cycle or procurement cycle is itself a 90 days cycle. So 90 days plus 90 days on the bill side becomes 180 days. 180 days ideally will give me around 2 cycles in a year. With 20% of the limit, how it will be, it is going to happen. 40 lakhs of limit, maybe 10 lakhs my own funds, 50 lakhs, 2 cycles that I will be able to achieve only 1 crore of turnover. Ideally, my requirement will be 1 crore a year or maybe 1 crore less margin. So 80, 90 lakhs of. So I move on to MPBN method. Working capital gain. My previous balance sheet and my subsequent balance sheet. I will create projected turnover and based on that the projected debtors, creditors, stock, etc., and then I will arrive at the. So this will still take care of the existing pattern of my business and from there, but it is only on a balance sheet date. Within that, gaps will be there, so I will have to extrapolate that. And the third one is operating cycle. So this is the ideal thing. So processing times, debtor time, stock time, maybe the advance paid to suppliers, etc. Everything is covered here. And if I deal in multiple commodities, then seasonal, non-seasonal, peak, non-peak, different limits could be there. So higher limit for seasonal and then maybe non-seasonal, the limits go down. Then again for 6 months period it goes up and again for 6 months period it goes down, etc. Or where particularly I am required to store maybe the seasonal commodities, the food grains, I need to store for certain time. And then for 3, 4 months, I'm keeping storing everything. So I need higher limits. And then for the next 8 months, I keep on selling. So it goes down. It is tapering down. So the best way to have it on an operating side. Now, why these things are important? So one of the exporters I met, he said, sir, we don't avail post-shipment limit. What happened? Why? Sir, our all orders are 120 to 180 days. And when we were getting this limit sanctioned, the bank insisted, no, we will give only for 90 days. Now, how do I get my bills of 120 or 180 days discounted within a limit which is having a upper time limit of 90 days? It is not possible for me. So I am not able to avail that. Now, these gaps, when you sit with the bank, that have to be cleared off. You have to discuss. You have to maybe check before it is sanctioned that what they are sanctioning, what terms are there. Otherwise, once the sanction is there, you are maybe going through another process of getting it corrected. Security could be prime security. The raw material, finished good export bills are the prime security for the bank, but the collaterals could be asked. So we talked about security. Now, security could be my office, residence, house property, factory, land and building, but also the liquid ones. Fixed deposits of friends, third parties, bonds, mutual funds, insurance policies, etc. And then I can always give a comfort by way of personal guarantees, third party guarantees, third party deposits. And additionally, the ECBC cover. So wherever bank has taken a policy, it is covering everything, but as an additional buyer-wise policy, separate policy can be taken. Now, this policy is not only a security for the bank. The buyer-wise policy is also security for the exporter. God forbidden if the buyer does not pay, I have somebody to fall back. Otherwise, the bank is going to take the money from my pocket. Anyhow. Now, wherever security is not there, there is a central government scheme, credit guarantee fund scheme for micro and small enterprises, where collateral free financing can be done for SME or MSME sector. So ideally, this is for manufacturing, not for trading exporters, trader export, merchant export. The limit here is now recently been increased from 2 crores to 5 crores. and there is a guarantee fund. So a guarantee fees is being paid to the government or this fund for the amount drawn or the limit sanctioned to the exporters or the borrowers by the bank. And here my cost could go slightly up because the bank may not be comfortable in keeping a margin of 3%. So they may charge you instead of 9.5%, 10.5%, they may charge. And then 1.8 or 1.5, whatever the guarantee fee as per the slab is to be paid. So my cost goes to 12%. But still, I'm getting money without collateral. And hybrid lending is also allowed. So if I have a security based funding of 1 crore and the bank is reluctant, I can take another crore from bank under the CGTMSE. So it can be clubbed and then 2 crore limit can be available. But I pay the guarantee fees only on 1 crore. Let us see some of the conditions. When the bank sanction limit, there could be sub-limits for pre-shipment and post-shipment. This means that bank is not going to give the entire limits in your hands. Pre-shipment is giving money in the hands of the borrower. But they will keep certain excess amount where they will only say, we will allow this if you are going to ship the goods. That is, once the goods are sailing or goods have been put on board, then only we'll give. Security related is always there. Then there is a margin. On pre-shipment, the bank could say 20% margin. On the post-shipment, they can say it is 10% margin. And the margin could be 10% on side bills, 20%, 15% on usance bills, or it could be 25% on the bills drawn on sister associate concerns, or zero margin on bills under LCH. Bank may also put buyer-wise limit, credit concentration. Out of this 2 crore limit, you cannot draw entire 2 crore on the orders or the bills drawn on a single buyer. Single buyer limit is 1 crore. All eggs should not be put in one basket. The bank is trying to restrict that, and you should also not do that. Orders from sister associate concerns, bank will be shaky because here also likelihood that you are not getting any ECC cover. So there could be certain limits there, and that there the bank may ask for a higher security also. Country exposure based on country rating. We will see how ECGC gives the country rating and how do they form these slabs. So even for the export, it is better that he should not only depend on his exports to one country. And we have seen people who are only exporting to Sri Lanka earlier or only exporting to Bangladesh in the recent past, how they have burned their fingers or now they are worried about their money. And ECGC condition is always there. So wherever the whole turnover policy is not there, bank will prescribe a condition to go in for a ECGC cover. One method is getting the limits sanctioned. But suppose I do not have limits, but I do business on letter of credit to be received from the overseas buyer. There's a separate window. Negotiation of export bills under LC. Additional window to raise working capital finance. No limits are required by the exporter. The bank which is negotiating the LC is taking the exposure of the risk on the LC issued bank. And that is why when you receive an LC, you must take the LC or you must take a copy of the LC or you must ask the buyer to mention the name. Before the LC is issued itself, you can ask the bank whether this bank, the bank which is going to issue the LC is worthwhile or not. Risk is on LC issuing banks. The rates are normally linked to our alternate reference rate, that is SOFR, secured overnight funding rate. But now banks are also giving negotiation in rupee finance, because in rupee finance you are eligible for subvention, so your cost goes down. Payments are normally made when once the documents are accepted by the issuing bank and once the confirmation is received, the bank is risk free. What should I see? What checks should be there? See that the LC issuing banks is acceptable to your bank or any other bank. This is free because I don't have a limit. I can go to any bank and ask. So suppose there is an ABC bank in Dubai which is issuing an LC, and my bank does not accept it. I can go to some other bank in India and say, if you are having a relationship with ABC and are ready to do the negotiation, I will open an account there. Or you negotiate the document and put the money in my account with bank A in India. Get this LC checked before LC is established. So your bank, which is going to issue an LC should be got checked before the LC is issued. Because once the LC is issued, you cannot, maybe the buyer will not agree to change the bank or it cannot be done. But ideally, ask for a draft LC and LC opening bank. Get a draft LC. Draft LC is what? Everything is there. You can check whether the conditions have been put in there are conducive to you or as per the contract or not. Understand preparation of error-free documents. One of our gurus said, if you are not able to prepare the documents as per the terms of LC, don't go in for an LC transaction. Because if you are not able to prepare the documents, you are already giving a leeway to your buyer or your buyer's bank to maybe reject the documents. You lose the shelter under LC or UCBDC if it's an error, if the documents have got errors or discrepancies. Check whether bank is negotiating documents without recourse. Without recourse is that once the bank has negotiated, they should not come back to the exporter and claim back the amount. Because now they have taken a risk on the overseas bank which has opened the LC. Why this point is here? I am enjoying a limit with one bank and I asked the bank to negotiate the bill and the bank has negotiated the bill by earmarking my limit. So if they have earmarked my limit, then it does not remain without recourse. It becomes with recourse only because in a limit bank will always debit my account. It should be over and above the limit also. Use this as a window to additional working capital. Even if I am enjoying a limit of 2 crores from a bank, but in between I receive an LCs which are of a good banks, then I can get the additional funds from the same bank or other. Let us talk about credit insurance. Now, the latest is that beyond ECGC, some other organizations, some other insurance companies also offer credit insurance. And I know of, I think, New India Insurance is one company. And now we are going to have some insurance companies from Gift City, Gandhinagar, our maybe ISFCA, that the insurance, export credit insurance is going to be provided. ECGC is one organization which is a Government of India organization. It provides credit guarantee to banks and the financial institutions which are into export finance and also to exporters when they take an exposure on the buyer by giving credit facility, use and spill drawing for them. Whole turnover policies are there for banks on pre-shipment and post-shipment side, which we call export credit insurance for banks. And there are, for exporters, there are turnover-based, buyer-based, country-based policies. There are standard policies for exporters where up to 90% risk is covered on commercial or political risk, but it does not cover import license related dispute with the buyer, general insurance clauses, exchange laws. So whenever I am getting, even I am under an ECG policy, before making shipment, I should know whether the buyer is having the import license or not. If he does not have, and I ship the goods, and if suppose those goods are required to be auctioned, ECG is not going to pay me. And some specific policy, single exposure policy on one buyer, multiple buyers, consignment policy, construction policy, services policy. Different policies are there, and for that, different conditions and different things. Now, the major thing what I want to emphasize here is that even if your bank has got a policy or you take a policy, you must go through those conditions and abide by those conditions because even if you have an insurance and tomorrow if you don't get the money from insurance, then you are at risk, you are at loss, and your premium also goes waste. ECGC also publishes from time to time country risk ratings from A1, A2, B1, B2, C1, C2, D1, and D. Sorry. This is on a short term duration. So maybe A1 is USA, Australia, Singapore. A2 is UAE, Thailand, Saudi Arabia. And now they have put Uruguay also there, which was earlier B1. In B1, it is moderate risk, Panama, Taiwan, Namibia. Now, Fiji was in B1, it has been downgraded to B2. So, from B1, one country, Uruguay, has been upgraded, Fiji has been downgraded. In B2, moderate risk, Jordan, Barbados, Bolivia has been upgraded from C1. Bolivia earlier C1, it has gone to B2 now. Similarly, in C1, moderately high risk, Russia, Iraq, Turkey, Gabon has been downgraded from B2 to C1, and C2 is high risk. Pakistan, Myanmar, Ethiopia, Ukraine, Djibouti, and very high risk Afghanistan, North Korea. Now, why this is important? In an export finance session, this is important because if I am borrowing money from a bank and exporting to Greece, I am responsible to bring in the money. If I'm exporting to Afghanistan or Burundi, I am responsible to bring in the money. Bank is anyhow going to take the money from you. So risk categorization, even for my own business, I should do. Factoring is another method where I can raise money. So it is an approved method of financing. They also do certain other aspects of works like debt collection. Sorry, I just skipped. Debt collection activities, reminders to the buyer on payments, etc. Now, currently there are several factoring companies in India. The major ones being SBI Global, Canbank Factors, Drip Capital, India Factors, etc. The financing is their major function where they keep 20 to 25% of the margin. And this is largely on a credit without recourse basis. So there is a credit protection. So they also take insurance on a credit side from the some external insurance agencies. Now, once a factoring is done, they normally would send reminders to the buyer on payment, maintain your book, and we will see how they will sanction to you. Assessment of the financial status of the exporter. Firstly, so several of the factors in India now have a condition that we finance only to those exporters who have a turnover of 20 crores, 25 crores. So they don't touch the smaller ones. But there are some other which say that okay, if you are in a business and if you have a 1 year past track record, we will do your factoring also. Then they also assess the risk of the importer because if it is a without recourse, entire risk is being taken on the importer. They do the financing, this is a major important part, and also follow up with the importer on payment. Exporter, so what is the process here? Exporter applies to factoring company. They will assess the limits based on your entire turnover and say sanction a limit of $1 million. And then within $1 million, they will ask you to provide the list of the major buyers. So on say one buyer, they have given a limit of $500,000, another 0.3 million, etc. Then there is a documentation part. Some people charge upfront fees, processing fees, etc. So when you make a shipment, say of $1 lakh on A, you have to submit the document to either the factor or a nominated bank. These documents are transmitted to the buyer A in USA. Through the factoring agency's own party there, it is accepted there. The factor pays you 75 to 90% amount here. The bill is accepted by A to be paid on due date. Now the factor has to follow it up for payment on due date, before due date, however it is paid. Once the payment is received, then that account is done. So if they have paid you 75%, out of 25% balance amount, they will recover their interest charges, difference balance, and paid you bill balance. Factoring provides liquidity without collateral. So this is a collateral-free financing, slightly higher in cost, but at least I have funding on the port ship. Some terminology is used. Advance percentage is 80 to 90%. Maximum credit period is given so that I can draw bills only up to 90 days or 120 days. Then there are different charges or fees, setup fees, establishment fees, assessment fees, handling fees, factoring commission, discount rate, various is there. And even in today's terms, if I see that 5%, 5.3 is the SOFR, my total cost could be around 10% plus in dollar terms itself in a factoring, but still I am getting money. Now, certain aspects to watch. Last two slides where I have put in certain points which an exporter should watch if you are availing limits or if you want to avail limits. Points to remember: sufficiency of limits. If I'm hand to mouth every day, then I'm going to default. And default means penal charges, penalties, making the track record bad. So sufficiency of limits, sufficiency of funds, my own funds and time. Renewal of limits in time. If I don't renew the limits, this is a transaction banking. My limits are going to be blocked on X date. So the renewal now, 90 days before the due date, you get a reminder. Even if you don't get a reminder, put your own reminder. Submit the documents in time. See that your limits are renewed at least 15 days, 1 month prior to your due date. Monitoring of pre-shipment, post-shipment dates, because post those due dates, you are going to pay 2 or 3% additional interest. You are going to lose the subvention benefit. So your cost, your interest rate, which is 6.5% now, maybe if it is overdue, for that overdue period, you are paying 11.5% or 12.5%. Timely extension of EPC, suppose the shipment is getting delayed because of certain reasons. Before the due date, you must go to the bank and get that extended by submitting the requisite documents. Application of forex rates. So if I am availing foreign currency PCFC, so I must see that what rates are being applied, and if it is to be crystallized, then I get a hit again there. Watch all due dates is an important mantra here. The second one being monitor due dates for bills purchased and discounted, because here also that overdue concept will be there. So and see that your buyer pays in time or within the time. He does not maybe push it beyond the due dates for a longer period. For the foreign currency borrowing in PCFC or bill discounting bill purchase, there's a concept of crystallization. Your foreign exchange exposure is delinked from your limits. So whenever it is delinked, you are paying additional money to the bank by way of margins. That is additional cost to you. Booking of forward contracts can be done for PCFC. So you can just see that if you book forward contract, you can reduce your cost. Ensure compliance of ECGC guidelines, whether the policy has been taken by the bank or you as an individual. See that all conditions are there. If you are not able to understand, go to your bank and ask them, go to ECGC and ask. Negotiation of bills and factoring, use this as an additional tool beyond your limit or maybe as a collateral free finance. Watch exchange rates and watch your limits. So this is all from my side. Learning never exhausts the mind. Keep learning, keep saving yourself something, do better for exports. The country needs huge exports now. These are my credentials, my details. Beyond this seminar, also, if you have any questions, you can just come back to me. Just drop me a WhatsApp, just drop me a mail. I will be glad to resolve your any of your issues. If you have any issues on the compliance side, understanding side, we also run a unit where we support for current account and capital account related irregularities which have been created, maybe long pendencies of bills, bill of entries, FDI, ODI cases, etc. Thank you all for your patient time. And now maybe I hand over back to KK Gupta sir. Thank
Thank
you, sir.
you.
Thank you very much.
Thank you, Gaurang sir. I think you have explained very nicely what are the requirement for the exporter and how it is assess the limits and what are the difficulty envisaged by them and how you can help it or how other people can help it by the ICICI Bank. Now we are with us is Santosh Pandey sir, who is a product manager ICICI Bank. Sir, give your thought about the export credit, how your bank is helping the exporters, especially SME sector. So I hand over to Mr. Pandey sir, please.
Yeah, thank you. Thank you, Mr. Gupta. I'll just share my screen for the presentation. I hope the screen is visible.
Visible video. Please carry on.
Okay, thank you, thank you. So myself, Santosh Pandey here, product manager from ICICI Bank. So before we move on to the core topic over here on export credit from ICICI Bank, let's understand what is the macro view of Indian exports as such. So if you can see here, the growth in Indian exports has been not to that yeah, satisfactory mark as such. So in FY23, we can see our merchandise exports was 447, which has declined to 437 USD billion in FY24. Service exports is the one who has probably held some ground, and from 322 billion dollars, it has moved up to 339 billion dollars. So overall exports, what we can see here is basically just a marginal increase of less than 1% as such. As per Federation of Indian Export Organization, the estimate is $900 billion in FY25, from $777 million in FY24 as such. So the major sectors who have contributed for this particular uh, growth in the Indian exports has been the engineering goods. So we can see here your
Bank
petroleum products,
में
gems and jewelries, chemical, pharma,
then
and no doubt service, IT, and ITS.
बोलिए आप बताइए एक मिनट आप बताइए
On the MSME space, we can see here the total MSMEs registered with us as of FY 24 is 4 crores. A major part over here, and then the major share in the overall yeah, MSMEs is 97.7%. So major part is being covered by the micro space in the uh, MSME sector as such. So, as we speak, it is close to 46% as such has been the contribution of exports to the overall exports of India by MSMEs. So, we can see almost half of the India's export has been controlled by the MSMEs over here, and this number will surely increase in this uh, coming year. Looking at the thrust what the Ministry of Commerce is having on the MSME sector as such. The outstanding export credit book as such for the entire nation of all the scheduled commercial banks is two lakhs 17,000 crore as such, and we ICICI Bank as such is having a share of close to 8 to 9% as such for from this space. We move on over here. So you can see here ICICI Bank is having its vintage of 60 years in this country, to 23.64 trillion INR has been our consolidated assets. We have our presence through our branches in through we have more than 6,500 plus branches in India, 17,000 plus ATMs we have presently in India. So this is as of 31st March 2024. Definitely, these figures have increased as we speak in September. So these are the our top five stakes and interest where we have ICICI Prudential AMC, which is our ICICI asset management business as such, which is a leading AMC at this point in time with an AUM with an AUM of 7.2 trillion INR. ICICI Lombard, here we have our stakes and interest, which is the fourth largest general insurance company. ICICI Ventures, it is our alternate asset management company, uh, which is there in India, and we have our stakes over here. ICICI yeah, Securities is there in India, which is a leading brokerage house having brokerage business and investment banking business. Then ICICI Prudential Life Insurance, which is the first life insurance company to get listed on NSE. So this has been our lineage and our stakes and interest where ICICI Bank is there at present. So we move on to our core topic of how ICICI Bank can help you in getting pre-shipment finance, and what are the benefits here once you come to ICICI Bank, and how you can manage your pre-shipment finance in ICICI Bank. So the first benefit what you can get is the Insta EPC facility. So Insta EPC facility is nothing but which is a real time credit of your drawals of EPC INR into your operative account. So we'll cover this thing in a bit in detail, but here in a nutshell, I can say that this is basically a service. It is a transactional service, and not a limit setup service. This is not a loan actually. This is a service what we are offering to you free of cost, without any charges, and no additional documentation as such. It is only to facilitate your local vendor payment for pre-shipment your finance as such for your packing credit requirements. ICICI Bank is not charging you any prepayment penalty as such for your PCFC prepayment. So, in case you have a PCFC with ICICI Bank and you wish to prepay due to your money what you have gotten and you don't want to pay additional interest on your PCFC withdrawals as such. So we do not charge you any prepayment penalty as such. Other banks are having some charges in your a percentage on outstanding amounts. Quick repayment of packing credit through branches. So we have now given powers to our branches. Right now, you will always see that in most of the private sector banks that the powers are with the central team. Now, very slowly and steadily, we are coming to the model wherein we are giving powers to our yeah, branches. So once the packing credit repayment is done, you will be able to get the fresh disbursement of EPC PCFC in your current account on the same day, and you can meet your packing credit expenses on the same day. You don't need to wait for the other day to come. So here, since we have given the access to the branch is able to knock off or repay your yeah, packing credit what you have from ICICI Bank as such. Now, there are many customers who say that the PCFC interest, what you are charging, should not get debited from our current accounts because the interest amounts are on the higher side, and the rate what is applied is basically the card rate of the bank, which is actually not going well with some customers because the PCFC interest quantum is higher. So here we have allowed such customers on application basis that they can use their EFC account to repay the or we can say that to service the interest of their PCFC loans from ICICI Bank. Now, in ICICI Bank, the disbursement part is totally digital. You don't need to visit the branch. You just need to apply for your packing credit disbursement, both EPC and PCFC, from your office itself. No need to send your person or no need to send any physical documents to the branch. You yourself can input the details in a form which is already uploaded on our trade online software. So the disbursements for EPC PCFC is done through trade online software of ICICI Bank. You don't need to visit the branch. Yes, we have this particular facility for our good track record customers, where we are giving a waiver for submission of purchase orders. So in lieu of purchase orders, we are taking order statement from such customers. So if you have a customer who is basically not in a position to give purchase orders for each packing credit or PCFC disbursement as such, which is a regulatory requirement by the Reserve Bank of India. You can take an order statement. You can take an order statement which is approved by RBI, and you can give this order statement to your branch, so that branch will never ask you any physical purchase orders for that particular disbursement as such. Now, yes, I think the inter-subvention part is already covered here. So ICICI Bank is a part of it, and we are giving the inter-subvention into your current accounts. So the day when the interest gets debited for EPC INR from your current account, on the same day we give the credit for EPC in your for subvention in your current account. So the debit and credit, debit of the contracted interest, or whatever is the interest has been fixed by the bank for you, is gets debited from your current account. On the same day, we credit the inter subvention part in your a current account. There is no delay as such. Now, one important point over here is that many of our customers, and also I think industry at large actually is not well aware, or I would say the subvention part is more popular with packing credit. But here I would like to clarify that this particular scheme is also available for post shipment your facility what you're taking from your bank in INR. So it is the inter-subvention scheme is available for pre-shipment and post-shipment. That is for EPC and for post-shipment in INR, what you are taking from your banks. So please note this is a very important point. And I think most of our exporters are missing on this particular point that they get the a benefit of the subvention for both EPC and post-shipment INR for their disbursement, what they're taking from the bank as such. And here it's just 3% now for MSME manufacturer exporters as such till 30th of September 2024. So this scheme will get closed by 30th of September 2024. We are not aware about any extension, or there is no information presently of an extension beyond 30th of September 2024 for intervention scheme. Now, in ICICI Bank, you get a single dashboard as such for all your advices. So whatever transactions you are doing from ICICI Bank, it can be your disbursement transaction, it can be your extension of your existing packing credit with ICICI Bank, it can be your interest what is charged by ICICI Bank, what is the rate the bank has applied, what amount of interest is got debited from your account, uh, what is the due date of your packing credit from us. All these advices gets sent to your registered email ID with ICICI Bank. So you don't need to follow up with anybody in the banks for any advice as such. You don't need to wait for your advices from the bank as such. It gets emailed to your registered email ID from ICICI Bank, so you can have a track of this particular transactions what you're taking from ICICI Bank as such. So there are 8 specific types of advices which we share with our customers. Yes, for pending orders, it's been a regulatory requirement by Reserve Bank of India that for every roll of EPC or PCFC, that is packing credit in INR or packing credit in foreign currency, some acknowledgement or some underlying has to be there from the importer abroad. So the purchase orders or LC is works as a proof of finance, or we can say as a proof for need for finance as such. So these disbursements which where you haven't submitted the purchase order, it gets reminded by the bank through our Trade One View portal as such that these all disbursements are pending for submission of purchase order. So at in one window, you get the entire history of your disbursement where you haven't submitted the purchase order. So it becomes very handy for our customers, and they are using this particular facility to submit the uh, purchase orders or LC with ICICI Bank. Now, yes, so this is the Insta EPC facility as such. So as I mentioned, Insta EPC facility is basically a facility wherein the disbursement proceeds. That means the draw of your packing credit INR gets credited to your operating account or current account within minutes. So in less than 5 minutes, the time you give a request to the branch, be it physical or be it non-physical, that's on Trade Online portal as such, your current account gets credited in less than 5 minutes from ICICI Bank. So this is one of the beautiful facilities what we are having. It actually enables you to pay your vendors on time. It's instant. You can see the benefits of this particular scheme here. There is no separate application from your side. There is no additional charges for this particular facility as such, and money is available to to meet your pre-shipment expenses, because we have seen cases where our customers get calls from their vendors to pay the money on time. Otherwise, the shipment will get delayed as such. So, just to give this comfort to our customers, we are offering this particular facility called as Insta EPC facility, where money gets credited to your current account instantly as such. So all your disbursement request, what you are giving from the branch or you're giving from the trade online portal as such, it gets credited to your current account in less than 5 minutes as such. Yeah, this was uh, all about the Insta EPC facility as such. Now here there are some exclusions for this particular facility. This is not allowed presently for PCFC. It is not allowed for foreign currency packing credit as such at this point in time, because it's in the stage of development. It might take some time to have this particular facility. Running account facility only. Yes, it is not for order-based facility customers. So it is only for those customers who have been given running account facility in their sanction letters by ICICI Bank. Customers should not be in RBI caution list. The purchase order pendency should not be beyond 30 days, and the customer should have an LEI number if the sanctioned EPC INR limit is more than 7.5 crores as such. So LEI number is mandatory only if you have a limit of more than 7.5 crores with ICICI Bank. And last but not the least, there are some a segment of exporters which are excluded from this particular scheme, or from this particular facility. That is the diamond exporters, service exporters, and sub suppliers as such. So this is it from me. But before I could end up this, there's one a piece of information which I would like to share with you, is that now, as you would be aware, that the interest, sorry, the interest subvention scheme of the government of India has got extended till 30th of September 2024 for MSME, a manufacturer and exporters as such for 3%. Now the merchant exports segment is excluded, is totally excluded from this particular list. Now, you might have an option over here to reduce your interest rates. Now, here I can see we have got some solutions from Mr. Gaurang Masavda on how we can reduce the interest of your loans. Now, here RBI allows to take a particular packing credit in one currency if your PO or your deal is in other currency, and both should be convertible currencies. So if you have a PO with say which is in USD, so in USD the loans what you will get is with a benchmark of SOFR, secured overnight financing rate, which is close to 4.9, I think, almost 5% as such, which was 5% plus last, I think, up till now. So it is 5%. And here you can get the same loan in Euribor. Euribor is 3.5% at this point in time. So there is a cost saving. There's a cost saving on interest to the extent of 1 to 1.5%, and both are convertible currencies. So, in case you're not eligible for interest subvention, it makes sense to go in for a PCFC as such in other convertible currency. Yeah, so that's it from my side as such. So over to
Thank you, Santosh sir. So I think you have rightly covered an ICICI advantage by dealing with your bank for a packing credit for exporters. I think that is the main issue. which were dealt very nicely. We are thankful to you. Now there are some questions which I request Gaurav sir, please give your reply.
Yes,
So please, I think it is available in your screen also.
yes, sir. I
Please,
just seen that.
yes, please.
Sir, first question is by Mr. Sarjeet Pal. How many rupees required for foreign trade? Sir, the requirement could be anything, the way you want to conduct your business, how big you want to do your business. But another way is that without money also you can do foreign trade. Buy goods from your supplier on credit and sell on cash. So without money also you can do. So there are various modalities to find find that the how you are going to start, whether you require certain capital or not, or maybe with some basic amount you can start. Find somebody. Try to become a export department to some domestic manufacturer so that he is yours. Your entire turnover you can take from him and then sell on credit or sell on cash so that you don't have to invest anything. Either your buyer invests or your supplier invests or your supplier gives you advance. Any of the modalities could be worked out. One question is there, what are the other options other than LC? So if the LC is not there, then what you are doing is you are sending either the documents on collection basis, site or usage through the foreign bank, or you have an advance payment mechanism, or if you are knowing the buyer very well, then you can give on credit and send direct goods to them also. So all modalities are there. Try to assess the risk, try to assess the buyer, how well you know him, how long you have been knowing him, all these things, and then take the steps. Dr. Jabbar, one question from him is that can we get SBLC from overseas bank where we are exporting goods? Yes, sir. SBLC is another method. Is it similar to bank guarantee, where SBLC can be there for an X amount, and every month when you are drawing, if the other party can pay you. If he does not pay, say within a reasonable period, maybe 30 days from the date of shipment or something like that, then you can draw on the SBLC. So SBLC is nothing but a guarantee, and it acts. Earlier times we used to have that predated checks, PDCs. It can act as a PDC for you in case the buyer does not pay you. One Mr. Manoj is asking, is there other RBI guidelines for exports? Yes, sir. For exports and export finance, other guidelines are there. We have had other some seminars where we understood about the export bills and payment related guidelines and maybe export finance guidelines also. There are several things, how to handle the documents, how to submit the documents to the bank, what is the timeline in which you should get the payment. So please do attend some of our other seminars. Try to go through YouTube and find it. If not, then put a request to Pandi sir. We will arrange another seminar on export related guidelines sometime soon. I think a couple of more questions are there. Uh,
Thank,
one question for Mr. Santosh Pandey. We are
Yeah,
a
yeah. So,
subsidiary of
Mr.
UK based
Hmm.
company.
Correct, correct. So there's a question from Mr. Vinay Mehta that we are subsidiary of UK-based company in India and shareholding is 100% to UK nationals. Will be eligible for EPC. Current export is around 60% of total, and we are in business since 2006. So yes, Mr. Mehta, you are eligible for EPC, export packing credit or export credit as such. Even a post-paper finance you are eligible for. Depending upon your financials and the collaterals what you are providing to us, you should get a packing credit loan from ICICI Bank as such. Your shareholding doesn't matter while giving finance for exports from ICICI Bank. So yes, you can please contact your nearest branch, or you can write to us. We will approach you. We will call you, and we will discuss with you on your current requirements as such. So Palash is there from my side. Uh, Palash, how we can get the contacts of Mr. Vinay Mehta?
we can supply you, no
So,
problem.
Mr. Mehta, if
Okay.
you can just type your email ID in the chat itself, I think bank will pick up from there and then they can get in touch with you. The another question from Mr. Manoj says, for exporter, how much time of credit accessible? It will all depend upon the type of order you have. If you have an order where you have to make a shipment for in 30 days, then that 30 days or maybe 30 plus 21 days of pre-shipment finance is there. If your order says that your buyer is going to pay on 90 days, then you get a finance for 90 days further on that. It will all depend on order to order. And that is why I said that for your limit sanction is one part and your drawing of the limit is another part, because it is all based on your order or your conditions in the LC.
Thank you very much. I think we have covered very nicely. Although we have overstretched our time, again, we are thankful to our eminent speakers, Mr. Gaurang and Mr. Pandey sir, who excellently cover it. All the point, I think, all the reply of the questions, they have also replied nicely. This webinar is in collaboration with the ICICI Bank, and we are hoping that a further webinar will also be taken place in respect of your request. If any request you desire any webinar, such webinar, please let us know. So we will arrange for that. Even the Resurgent India banner and Association for Financial Advisor, we are holding mostly every week a one webinar under the banners of Resurgent India and the associations for that. So we are thankful to eminent speakers, and also we are thankful to our off-screen, our person, Mr. Rajan, Mr. Ayush, Mr. Parvesh, and Lokesh. We are thankful to them also, and other team members who are associated for this webinar. As a researcher in India, we are a merchant banker, we are investment banker also. And we are preparing the DPR and also conducting viability study for almost all the banks in India. And we are thankful to you. If any assistance is required from Research in India, we are also at your disposal. Thank you very much in the end, because I'm sorry for that, for extension of some time, because the subject was so much interested. So everyone wants ask some question for that, and I think please give us your feedback so that such webinars can be hosted further also. Thank you very much. After this, I close the session. Thank you very
Thank
much.
you, sir. Thank you very much, sir. Thank you. Thank you all.
Thank you, Dutta sir, and all the eminent speakers for very successful seminar, sir. Thank you once again, and stay
Thank
in
you,
touch.
sir. Thank you, Rajan.
Thank you, sir.
Thanks, Mr. Rajan. Thanks.
Thank you, sir.
Thank you very much.